What's up, guys? We are back for another episode of Jack of All Trades. I'm here with David and Sam. We're going to jump right into it here. I know the last couple weeks, where are we right now? We're kind of mid-February in 2022. So this is the first time that we've kind of had like market correction in, probably, what do you think, like 2 years now? Like, how long has it been?
Since the pandemic.
Yeah. So I don't think it was technically a correction. I think we hit like 9.5% off highs, and a correction's 10. So we're a little bit.
Was that the technical? I didn't even know that.
I think it was. It was like just a hair under like being an actual correction. But regardless, I mean, we can consider that a correction. So yeah, we just kind of want to cover that really quick because obviously anyone that's a new investor, a new trader, this really is like the first time in a couple of years that we've seen kind of that level of a sell-off with that kind of volume. So what I kind of wanted to talk about today, just like, really quick, like 15-minute episode or whatever here, is just for anybody that's long-term investing. Like we talk about this all the time. These things, they really just come down to time frame, right? So like if you're buying any stock or shorting any stock or whatever, like the main things that you need to keep in mind if you're trading or if you're investing or whatever, it really comes down to two things. Like the first one is time, and the second one is your risk parameters, right? So like how much range are you going to give the stock before you stop out? If it's a long-term investment and you have bad earnings or something, the stock drops, say 50%, doesn't necessarily mean you're going to sell. It could be a good opportunity to buy. So how do you look for buying opportunities, that sort of stuff. So I'll show you basically like what I do to look for entries, and it really is super, super simple because that's just the way that I like to keep things. We'll look at some individual stocks here. I'm going to look at NVIDIA first because it is it's a pretty technical stock. So when you look at something like this, it gets super scary. We're up at, 330, 340, sold all the way down to a low of like, 209 or whatever it was. This is one of my own personal long-term investments. I've been holding this for quite some time now. So, it's one of my bigger plays, but, stocks like this, personally, I'm always looking to add, if you're buying Amazon, if you're buying, the S&P 500, if you're buying like kind of any of these big name stocks, it's not really something where you're trading necessarily. It's more so something like, okay, like where do I look to get my best ad opportunities, right? So how do you know when is a good place to buy? How do you know when's a good place to sell? All these kind of things. And if you guys have been kind of keeping up with our videos, you know that I like to keep it very simple and that I just look for resistance lines and I just look at the candles and the volume. And those are really the three things that kind of tell me where my entries are going to be. So if we look at this chart here really quickly, the first thing, up in this area, once, like for me personally, once I kind of saw this rejection here, I sort of had a feeling that we were going to start coming off the highs. We kind of had like this big volume down here. On this day, we had a huge run up, gapped up, and then we had kind of a bigger volume sort of rejection off of, that kind of 345, close to 350 area. So that's sort of a big mental number, like when I'm playing cheaper stocks, I'm looking at, whole and half dollars. So like really I can look at this like, $3, $3.50, $4, or, 300, 350, $400. They're just kind of mental lines that people sort of gravitate towards. So as this thing started coming down, I'm thinking, okay, great. Let's see how far it's going to come down. Like, where can I maybe buy? Where can I maybe trade this? Hold a couple swing positions for a few days. Make a quick 5-10% or whatever I can make on some bounces. So really, you just want to wait, right? So the first thing that you want to do is draw where your support and resistance are. And we've done this a whole bunch of times, so we can throw a whole bunch of these in. Like we can start way down here, right? So we have these two tops here from way back in 2020. And then we kind of climbed over, like we kind of bounced off it again, bounced underneath it. So like that to me is a pretty clear line. And then, just kind of work your way up. So we had this here, again, keeping an eye on volume. So we have big volume combined with a bottom or a top always becomes a support and resistance. So there's another one. We had another one kind of right there at this bottom. We had another one sort of right around here. And then, you can put your tops on there as well. So we have, this top up here. Oh. This top here. And then, we have this top up here. And then that's pretty much it. Like for this cluster up here, I mean, you could draw some lines at the bottom. But to me, like these are kind of the main, like these are longer developing moves. So these are sort of the lines that I'd be a little bit more interested in. It looks a little bit messy when you put that many on. So like, you can refine it a little bit more and really just kind of take like this big top here, this bottom, the next big top, the next bottom, and work through it like that. So as you can see, we did basically bounce almost to the penny off of this support line here, which was drawn from this top way back in, what is that, July 2021. But how do you know, right? Like, how do you know when to get into this? And I've talked a lot about, my shorter term trading. I've gotten a lot more successful when I look for what I call confirmation plays instead of anticipation plays. So depending on the setup for me personally, I'll go in really small, like maybe, 10, 20, 30% of what my max size is going to be into a level. And then that way, if it does break, I can stop out for a minimal loss and then I can, jump back in later. But depending on the setup, I might not even do that altogether. I might just wait for a confirmation. And once I see a confirmation, the benefit to that is it's way lower stress for me. And I can also get way bigger size onto the play. So instead of, putting a little bit of money in over a huge range, making a big range back on smaller size, I can make a smaller range on way bigger size, and it's actually less stress and more money because I can load into it a lot more because I've been proven by the chart that I'm correct. So this is kind of one of those situations here. And I think David, you and I pretty much both bought this on the same day. And I'd like to point out, I think I got $1 lower than you did.
Oh,
Pretty sure I had like 230 and you had 232 or something like that.
I did, yeah. Yeah, it's 232.
So we'll put it this way. We weren't talking to each other. I don't know what David was looking at. You were probably using Fibonacci lines because that's what you like to use. I was using what I'm showing you here. We both came, my way is better, but we both came pretty close. So
listen, I reached the same number. I'm just like, I like to front run a little bit because I'm a little insecure like that.
Oh, okay. So
front run guys like you.
Yeah, right. All right. So anyways, so what do we look for? We've talked about these types of candles right here before, right? So this is what I call, whenever you see these big wicks, that's an indication of reversal in trend, right? So if you have a big wick on the top, this isn't really a good example because it's already in a downtrend, but like this one up here is a good example because it doesn't have crazy high volume, so it's not the best example, but you want these candles to have the biggest volume, in the relative area. So like this one, for example, this is kind of why I thought we were probably going to turn around, is because we have this big top wick, which is like, I like to see them like at least half the size of the whole candle or even more. Like, I mean, if the candle opened down here and we had like a monster top wick, like that would be a very clear indication of a reversal. Something like this green candle right here, only in the other direction, like that's a really clear indication of reversal. So when we look over, down here at this one, so what I'm seeing is, this bottom wick is bigger than half the candle. If you look at the volume on this right there, it's higher than the last time we had a candle this high was, what is that, 2.5 months ago when it first really had that big push. So that's significant. We're also, I have these two support lines drawn right here. So that's significant. So that's basically why I bought this right here, is I see it, we've come down for like over a month now. Up here, we're not really hitting any major lines. There's nothing in the volume. Like, we have this candle here, which is a reversal candle, but we're still way up here. We haven't really sold off enough to convince me that we're going to bounce. And there's not enough volume on that candle to convince me that that's the bottom either. That I think really was just a function of this 300 mental number right here. I think that's really all that was. So when we get down here, we're getting towards that 200 line. We have, long-term support and resistance. We have that reversal candle with the big bottom wick. And we have what I think really is, in my opinion, the most important is the volume, because volume shows interest. volume always shows how many people are trading it, how many people are buying it. So a big green reversal candle like that on big volume, that tells me that more people are buying on this day than they have in the last 2 months. So when I combine that with a support level, to me, that's where you want to buy it, right? So if you're going to go long term, if you're going to, play this for, a week or two long swing, you get in $230, you sell it up maybe at this next resistance here at this base, just $255 or whatever, you can make, 20, 30 bucks a share in a week if you want. Or in my case, I'm just holding this for the long term. So like, even if it comes down lower, I'll look for another entry and just kind of start doing my thing, playing around it or whatever I'm going to do. But that's really what I look for. That's I think a key thing to watch for if you're looking for a reversal in trend. So we can look at that as well on, I don't know, maybe something like Apple. Yeah, so we had a similar kind of thing here even on Apple, right? So right off the bat, you can draw this line here. That was your last kind of major top. I don't think there's anything else in that area. And we came down, broke through it here, bounced off of it, and then we continued the uptrend. And we have the exact same thing again, right? So like, the only two resistance lines I sort of see in this area are maybe kind of these two spots here, something like that, because we kind of bounced off this area a few times, right at this 168 line. So we just do the same thing, right? Like I'm looking down here, and we have that exact same candle, right? Like we got the big bottom wick, big rejection, big volume. In this case, it's the biggest volume in roughly a month, maybe 6 weeks. And it's right off of a main support and resistance line. So again, that's the sort of thing that you look for, where you can go, okay, let that day play out, let it close, and then get back in. And then if it starts to trend back up, you can add and take your profits, or you can just use that as a a good place to enter for a long-term hold. And I think the S&P even did something similar again. So yeah, like even the S&P, this is actually a really good example because it has a ton of volume. But if you look at your levels again, I mean, this is pretty clear line that I see right here. We hit it here, bounced off of it twice, continued the uptrend, and then when we started selling, we have the exact same thing again right here on this candle, right? Big bottom wick, it's maybe a little over half the size of the candle, and there's the volume. There's volume as you're buying, right? Big green candle, and that, I think that's the biggest candle in, I don't even know how long, like since, let's go back even further here. Yeah, that was the biggest volume day since March of 2020. So like that's very, very clearly, a reversal right there. So biggest volume day in 2 years, right off a support line, huge rejection candle, big turnaround, and that's your buy zone. It really is that simple. I mean, you don't know anything about economics, I mean, or the markets or what's going on in the world. I mean, look at the volume, look at the candle, and where is a clear support and resistance line. It's in my opinion, that's a pretty easy one to spot. The volume in this case is very clear because it's the highest in 2 years, and your bottom wick on this candle is bigger than half of the candle itself. So you see that? I mean, it's pretty straightforward in my opinion, and it really is that simple, guys. Like you don't have to overcomplicate this stuff by any means. Like I don't have any moving averages on here. I don't have any crazy indicators. I don't have lines going all over the place. Like this is all I look at, and it works. So
I want to add though, you could do this because you're battle worn, and you've got like the confidence and whatnot, right? Because it's like, remember being at the beginning, it's like, yeah, you do the technicals, you're like, I know I should buy here, but you see this giant fucking red candle coming down, you're just like, fuck, man. That fear, right?
True, but that's where it comes down to time, right? What's your time frame on this? So like, for example, like say you're a long-term investor like me, like I don't play the S&P, or like sometimes I play stuff like Apple or Microsoft for swings, but not really. Like most of that stuff I'm just investing in. So like for me, if I buy the S&P here, like I'm totally fine if it goes all the way down to say $320. Like that's fine. Like right now, like, we're selling off a little bit again. So this could just blow right through that bottom and we could sell off another, $100, another $150. Like that doesn't matter to me because all I'll do is I'll just do the same thing again. I'll just start drawing more lines. I'll look for that same candle with the same volume. Once I see it, I'll buy a little bit more. And then if it keeps going down further, I'll just do the same thing again. And then eventually, the market is going to turn around and I'll have just worked my average down. And then I can just start buying in even harder and even quicker on the uptrend. And, that's when you get those big bounces. And those are the time periods when you can make the most money. So
Well,
that's why the most important thing is time, right? Like, what's your time frame on this trade? If you're going in with so much size that your time frame on an entry like this is only going to be maybe like a week, like maybe you're buying this, at $430 and you're planning to make $20 a share, and say it bounces because you have so much size on it, and it bounces up to say 445 and then turns around and it starts looking really heavy. Well, then maybe you just bail because like you're not prepared to leave that money tied up for a year or 2 years if we go into a bear market, whereas I am, right? That's the way that I play these things.
Right.
That's
what,
a good.
what I was going to ask was just that. What if you only have like a limited amount of money? So then you won't be able to keep buying those dips every time you go down.
Well, that just comes down to whatever your personal preference is, right? Like even if let's say you have like say you have like $3,000 or $4,000, then in that case maybe you just buy one share, right? And then you buy one share at the next lower level, or you can just buy all your shares off of this line, and then if it goes way down, then you just ride it down and you just wait for it to come back up if you can't put any more money in. That's the thing, right? Like the market is going to recover, like it's going to come back. It's just a matter of time. That's really the bottom line. I mean, like, you could have bought this at $480 or whatever, $479, and and then in the next 3 weeks you're down 10% on your position. Like it kind of sucks, and like maybe this goes down to $250. That really sucks, but guess what, within a few months, a year and a half, 2 years, 3 years, it's going to be back up to this level and it's going to be higher, right? It's no different than if we look way back here in 2020. Well, say you bought all your shares right here at $337, and then you rode this thing all the way down, 50 some odd percent or whatever it was. You just took a colossal loss for 6 weeks, didn't sell, and then you just held on to it, and then a year later you're back to break even. Okay, that's great. And then now here we are 2 years later, and you're up. What is that? I don't know. I can't do simple math. I'm a trader. 50%. Who knows?
Yeah,
You're up, right? You're doing well now. Like even after this, like you're at, you bought in here at the high as 340, and now it's at 440. You're up $100 a share, right? So that's it. It just comes down to time. Like the thing with any of the long-term investments, in my opinion, and like I am newer to long-term investing. I've been trading for a long time, but it really is just the timing. It's just the length that you're going to be in the stock, what you're willing to commit to put away, and then the way that you can set yourself up for success. It really just comes down to a couple factors, and it's one, never over investing, making sure you have enough cash on hand, making sure you're never going to be in a position where you're forced to sell a stock at a loss. In my opinion, everything that you invest in the market long term should basically be money that you absolutely do not need. Like it doesn't exist. You have to think of it as like a mortgage, like a house. So like if something happens, if your car breaks down, you can't just up and sell your house to fix your car. You have to think of a stock as the same way. Just because you can click the button, have that money instantly, you have to set yourself up so that you basically don't ever need to do that. So whether that means you need, $5,000 in savings and cash in your bank account, whether that means you need 10,000, 20,000, 50, 100,000, depending on your lifestyle, that's what you have to do. So just because, say you have $100,000 in the bank and you have $100,000 invested in the stock market, well, that doesn't mean you just want to say, oh, the market's going up, I'm going to take all my 100,000 cash, put that in the stock market because I'm going to make money on it. Okay, well, what happens now all of a sudden if the market crashes like this in 2020, crashes 50%, and then right at the bottom of this here, your water heater and your furnace and all explode and half your house catches fire, and you go, well, shit, I need $60,000 to fix all this stuff and repair my house. Well, guess what? Now you've lost $50,000 because you overinvested, and now you have to sell that to use the rest of $50,000. So you just lost $100,000 because you overinvested, right? So like you gotta, it's kind of like this weird mental game where you have to make sure you're just careful, make sure you always have those reserves. As much as we talk about, cash not really being great because it's deflationary by nature, you have to have cash on hand in order to cover any emergency expenses. Because if you ever put yourself in a situation where you're forced to sell a stock at a loss, that's how you're going to lose in the long run when it comes to investing.
Yeah, I think you make a great point. Actually, I think earlier in the week we're going to talk about this a little bit, how to compartmentalize your money or your finances, because it's been super beneficial for both of us.
Mm-hmm.
And I was going to say, like, the thing that helped me out was that my first investment account was an RSP, self-directed RSP. I think it's such a great tool because the money I put in there, I can't take it out. I mean, I can, but I'll be taxed to like it's income. So, I'm incentivized to keep that money in there. And because I mentally tell myself I can't take that money out, every decision I made in that portfolio in terms of trades, I was all like 10, 20, 30 years down the road. It was all
Yeah.
long-term decision making.
Yeah, that's really smart. Yeah, like what I've done personally, and again, this is just kind of like my own personal way that I set things up. Is I have X amount of dollars in long term investments, and then what I do is, as I get my salary, like my income from my job, I have a percentage of that where basically on a weekly basis I'm investing a percentage of that money, and then I have a savings account as well that's all cash, and then I have enough money to pay my bills, pay my mortgage, and all that kind of stuff. And I just kind of coast along. Like I'm accumulating wealth in the markets, but my actual cash value is staying pretty much stagnant. And then what I do is, like, if I want something, like say I want to buy an ATV, or I want to buy a boat, or I need a new car. If something like that, where it's a want and it's not like a need. Like if something breaks down, I have the cash for it because I have my emergency reserves. Or if something explodes, I have the cash for it. But I don't touch that for stuff that I want. So stuff that I want, what I'll do is I just stop investing into the markets for a few weeks or a month, or like whatever that time frame is, and just use all my income, and I just save that money. And then once I have enough to buy the thing I want, then I'll make the purchase, and then I go back to what I was doing before. Because like for me, I tend to be a little bit impulsive at times. So it kind of saves me from myself. It saves me from not just being like, oh, let's just get this right now because I want it, right? It kind of forces me to, like, okay, I need to save up for this thing. Let's think about this. It's going to force me to think about it for a few weeks. And if I get to that point and I kind of decide maybe, I didn't really need to buy that thing, then I could just put all that money back in the markets. So like everybody's different, but that's kind of like what works for me anyways.
I think that's a great contrast for the two of us. I think we sort of cover the majority of people's income situations where you have the steady income, steady job, and I'm more a freelance contract worker. And then so your strategy is to take a proportion of your paycheck and to put that into investing because it's consistent. So basically far in advance how much you take out, right?
Yeah.
And then so for me, freelancing it's a little bit different because it's almost like sink or swim. Like some days you make a ton of money, and some other days you have no money. So it's hard to figure out plan ahead, like what proportion. Like if I have, like, back in the day when I used to shoot weddings, just like for 4 or 5 months of the year I was like flush with cash because it was just one wedding after another. But then I could never use it for anything because going into winter is my down season. I'm like, well, if I get no jobs, then this money's basically what I'm buying groceries with, right?
Right.
So I couldn't put a proportion of my paycheck into it until about maybe about halfway through Christmas, and I'm like, I can see the next 3 months, and I'm like, okay, I'm probably gonna end up having like $1,000 or $2,000 extra. Then I can put that into my RSP or something like that. So it's a little bit more difficult, but actually that helped me too because when I opened my RSP, I had some money from my old company. It was about 6,000 and change, so I put that in there. Then the following, I think 3 or 4 years, I put like 1,000 or 2,000 in there each year. Then in 2016 was when money got tight, and then I couldn't. I decided I made the decision not to put any more money in there. I could have. I mean, I could stretch it, but like you were saying earlier, it's like now I'm just risking money that I might actually need, right? So I put myself in a very bad position of putting more money into the account. So I didn't. And then so I've only ever put like 14,000 whatever total in my RSP. And then at that point I was like, okay, Like this is like a personal challenge to myself. I'm like, okay, I'm gonna grow this shit, or it's gonna be whatever. But I'm not putting $1 in there more. I can't risk it. So I think that's part of like what somebody in my position would have to do. Just bite the bullet and be like, you can't risk it.
For sure. It's yeah, like everybody's in a different situation, right? So that's why it's very important to really think about these things, not just not listen to the news and get all excited about the hype and say, oh, the market's crashing, and then you panic and you sell, and then it bounces, and then it bounces past right where you sold and buy it, and like you get in one of those stupid things where you're buying at the highs and selling at the lows, and it just becomes a nightmare. That's why it's just really important, like you said, to just compartmentalize, put your money in different places, and just never get yourself in a situation where you're forced to sell something at a loss, because as long as you're buying good companies, they're going to go up. And like we've had bear markets at last years, and that's why if you put that money away, you have to be prepared to not have that money for years. And a lot of people don't realize that, so they get caught up in the hype and the excitement of things going up, and it's a bull market and this and that, and then they overinvest, and then that's when you hear all those really sad stories about people saying like, oh, we had this thing happen, I had to sell all my stocks, and then you just end up in these awful situations. And it's like we're kind of speaking to people that are like around our age who are working and growing and stuff, but then there's the other side of the coin is like people that are retired, right? So like what if you're retired, you're in your 70s and 80s, and then you go into a bear market and you're living off of your investments. Well, it's, in my opinion, it's the same kind of situation, right? You always want to have enough cash on hand that you can survive for at least a couple of years without having to touch those stocks. Because if we go into a bear market, then at least, even if you're retired, at least you have enough cash on hand where you can leave the investments alone, give it a couple of years to at least come back to maybe close to break even. And then, once your cash reserves are empty, then you can go back to selling stock and living off that. So yeah, it really just comes down to the time frame and not over investing. As long as those things are in check, in my opinion, it's really difficult to lose in the long game in the stock market. I mean, Warren Buffett is, he's the king of investing, and like he said it best. He says, the stock market's a vehicle for transferring wealth from the impatient to the patient, and it really is that simple. It's all just time frame. How long can you sit there, bite your teeth, watch your money go down, and then just wait and let it come back up, and you have more money. And like, meanwhile, everybody else is panicking and pulling their hair out in between. And you just don't want to be that guy. You just got to let it do its thing and relax, as long as you're buying good stuff.
Would you agree? Because I know it's helped me, but would you agree that it helps if you can view money not in its dollar value, but more like in percentages?
Yeah, I've never really thought of it that way, but I
It's
would
like
suppose.
you might do it unconsciously, I think.
Yeah, like the way that I think about it is I don't really think of it as like the money that I have invested. I don't really think of it as like available money, as cash. Like to me it literally, it's like in my brain it's just numbers. Like that's all it is. It's just numbers. It's not money where it's like, ooh, I have X amount of dollars. Like I could afford to do this, or I could afford to buy that. Like that doesn't even cross my mind, because that's not what it's for. Like for me, it's my it's my backup plan. It's my savings plan. It's my retirement plan. It's stuff that doesn't exist for decades. That's what that money is. So I don't even think of it like that. It's, to me, it's literally just numbers on a page, and I just want to see those numbers get bigger. That's all it is. I don't mentally equate that to material things, and I think that helps me a lot without, especially with the stress and stuff too, right? Because like if stuff's going down and you see that number getting smaller and smaller and smaller, some people might think, oh my God, like I was so close to being able to sell my stock and buy this new car that I need or whatever, right? But like for me, it's just kind of like, oh, well, okay, well, it's a bummer, it's going down. I guess I'll just buy some stuff on sale, and then maybe in 6 months I'll be back up where I was, and I'll be even higher because I bought stocks on sale, right? So it doesn't stress me out at all, because I set myself up originally, to prepare for this stuff, like to prepare for pullbacks, to prepare for bear markets, to be in this for the long game.
Were you always like that, or did you develop that?
I don't. It's weird, man, because I've always been a really short term trader, right? So like I've always been like, that's the way that I learned. That's the way that I got into it. But it doesn't like frighten me to watch things go down. Like I've just started investing, in the last like year and a half, 2 years or whatever. But anytime the markets like go, like, even like recently in the last week or whatever, we had our first correction. Like for me, that's my first correction that I've endured in actually having investments in the market. And like, my account went down, I have a lot of money in my account. So like the actual dollar value of it, that it went down was pretty significant, but it didn't worry me. It didn't stress me out. Like I didn't panic. Like I didn't feel any concern whatsoever. And I actually, like I said, I actually bought more of some different companies and some different stocks because like I know what they are and I know how long this game is. And like I said from the beginning, I mean, I'm okay if we go into a bear market for 2 years or 3 years or 4 or 5 years or 6 years, because I don't need that money and I have enough cash on hand to support myself. And, like I said, I have full-time income as well. So there's no, like there would have to be so many things that just fall apart in order for me to be forced to sell my stock.
So I was gonna say I wasn't like that in the beginning. I had to do these mental tricks to help myself. So that thing about looking at money and percentages, that helped me tremendously because because I'm a freelancer, sometimes I can only toss like a few $100 into the market, right? So then at first I'm always naturally even thinking, well, what's a few $100 gonna do? Like everybody thinks that, right? But then I started thinking, well, who cares? If I get 10% return on whatever the amount of money is, that's 10% return. Now, if my entire portfolio was 10% return, that's just beating the market, like, you know what I mean? So it's like I started tricking myself and like thinking like, as long as there's a return and it's a good percentage, it doesn't matter how much money, how much dollar value it is, right? So I'll go into a trade, I'd be like, even if it's $500 trade or it's a $1,000 trade, doesn't matter. If I get my 10, 15, 20% return on it, I'm like, that's perfect, right? And because I think in my head, like, well, if I have a $10,000 portfolio and I do 10 trades of $1,000 a year and each of them got me back like 10%, I just beat the market. Market's up 7% a year average. I just beat the market,
Yeah.
right?
And you can do that sort of stuff by doing what we talked about at the beginning, is looking for these pullbacks and playing those trades off those certain levels and support levels. Like those are the ones that you can go bigger into if if you know how to trade and potentially make money a little bit quicker, right? So that's kind of why, even though I've never been through a bear market myself, I kind of welcome it, because I know that just brings way more volatility. That brings way more opportunity for me to do what I know how to do best, which is trade and make way more money during those times. So like even though my net wealth will go down, I'm excited because I know that during that downward process, I'm going to be making a lot of money just trading stocks. And then once it turns around and it rips back up, once we even get back up to the same level that we were before, like, I'm just going to have so much more money coming up behind it because of the volatility that's involved in those markets from doing the little shorter term trades like we were just talking about at the beginning of the episode.
Yeah, yeah. I actually I did that with Bitcoin recently. That's twice now I bought the bottom, I think, if the 31,000 held. But so I have this one portfolio on FTX. I moved money there last May to get out of Binance for a bunch of reasons. But so that portfolio there, I've only ever done like, it's a series of trades, but it's all off two moves. And one move was the 29K bottoming last year, last June, July, whatever it is. And this most recent one, the 31K. And it experienced exactly what you just described, where it's like when the Bitcoin was selling off, yeah, my portfolio was down in total. But then I had cash to buy the dip. And now Bitcoin isn't back up to, its previous highs of 65,000. It's at what, 40 something thousand right now. But my portfolio is back even. It's already
Right.
even. So now if it went back up to 65,000, I'm up like 40%. And
Right.
that's from being able to buy the dip.
Yeah, exactly. Because you have cash on hand, you prepare for these things, right? Like it's the exact same thing with the S&P. Like we were just saying, it was at 480 roughly dollars at the peak. Well, if it sells all the way down to say $300, just for argument's sake, let's say it sells back down to the highs of the coronavirus, just as a level. So 340 roughly. So if it sells back down to here, let's say you started buying in up here at the highs, right? Well, all you have to do is do what we were just talking about. You can buy a little bit off of here, and then because that's a level, and then let's say it goes through. Well, maybe it comes off of this, 400 roughly level next. Maybe you buy a little bit more there because you see the same pattern. And then, maybe you buy a little bit more down here at 383. You keep kind of buying at the levels all the way down. And then once it gets down to, say this 340 area, let's just say that's where it turns around. Well, now you've been buying all the way down. So let's say your average is, $410, right, at this point. And then when you see it really starting to truly uptrend, you're getting like higher lows all the way up. You're seeing that full reversal. Then you can start buying in even more if you have that steady cash flow. And then by the time you get up to $410, well, now you're break even instead of when you're at 480. So now you're going to be, making 20, like 10, 20, 30, 40, 50, $60 a share on your position instead of just, buying up here and then just, holding it for the ride all the way through. That's why it's so important to, in my opinion, to not welcome a bear market or a correction or whatever, but to at least take advantage of it, right? Like set yourself up to be able to take advantage of these things because those are the quick moves, right? Like again, we say, you get 10% a year roughly on the market overall. Well, we just had a 10% drop in what, 2-3 weeks roughly. So in 2 to 3 weeks, we had the same move as you would typically see in an entire year, right? So that's why these things are so important, because if you can capture this and then you get this bounce back up, I mean, you can literally make 6 months to a year's worth of profits on a select amount of money in literally a few weeks if you're prepared for this stuff. That's why it's so important to learn how to at least recognize these things and know where the highest odds areas are to get in, because that's how you're going to make the most money the quickest. Like, yes, put your money in long term. Don't think about it. Just, put X amount of dollars in every month, no matter what the market's doing. That's totally fine too. Not everybody has time to learn this stuff and to be involved in it. But at the very simplest level, I think rewatch the beginning of this video, look at what we talked about here, because that is as basic as it gets. And that's literally all you have to do to at least pick the right levels to get in at. And then if it goes lower, you just do it again and do it again and do it again. And however you want to buy in those levels is a completely personal decision. Like whether you go in all the available cash you have right here, and then it goes way down and and that's it. You just sit back and let it do its thing. That's fine. Or whether you take a quarter of your cash here, get ready for the next dip, quarter on the next one down. However you want to do it is a personal thing based on your own life. But I think at least learning what to look for so that you're confident when when the market's turning around. Like I don't even listen to the news. I just look at the chart. I don't care what Kramer's saying. I don't care what CBC's saying. I don't care what I hear on Twitter. Like, I like on this day right here, I heard everyone, panicking. Oh, this is the end. Look at it. We've sold off for 5 days straight. Like the markets are going to crash. We're going in, we're going to sell right off below $400. And, and then I bought other stocks on this day because I'm looking at the chart and I'm going, well, you're clearly wrong. I can see it right here on the chart. Like you're clearly wrong. The chart is telling me that you're wrong. So I just ignore it, right?
Yeah. It's funny. I didn't take advantage in terms of profiting, but I did kind of mitigate some losses with that exact play that you were talking about, that dip. Remember, I'm down like, I think my portfolio is down like 48% of EMEA. I jumped the gun on that guy. Just kept trying to dollar cost average down. And I had one order for $9.44. It hit $9.23 on Friday. I got 2 hits, one on the TSFA, one on the RSP, 2,400 Canadian each. 2 days later, it's up 34%.
Yeah.
Like 34% on any stock, any time frame is pretty fucking awesome.
Yeah,
right?
2 days.
Yeah. So that capture mitigated my losses. And at a time when everyone's going, oh no, the world is ending, like this company's dead, it's going to go bankrupt or whatever.
Yeah. But that's what I mean. You can still play those bounces if you know what to look for. And like you said, at least mitigate your losses, right? So maybe you take a couple of those, and let's say for argument's sake, something fundamentally changes with the company and you think, okay, I got to just get out of this and eat my loss. Well, at least because of your technical analysis skills, you've been able to bring that loss down to a manageable level. So you're not just riding that thing down to the ground, right?
Yeah. Oh yeah. That's a good point. Like I'll eat losses, but like I'll try to eat as little as I can with whatever tools that I have in front of me.
Yep. Yeah, exactly. So anyways, I think we could probably wrap this one up here. I think that was good.
Yeah, it's great.
Yeah. All right. Thanks for tuning in, guys, and catch you next week. Make sure you subscribe. We're doing what we do, trying to give you good free info here, and everybody's making money.
See ya.